What is risk? Howard Marks, who's an investor that I've long admired and followed, says that risk is the probability of permanent capital loss. To eliminate risk, you need to figure out 100 ways to de-risk your investor's capital. All of the things that can go wrong in a real estate investment. Namely, what happens if this takes a lot longer or can't lease up or sell for what you thought it could. And make sure that there's plan Bs with any given project. If I'm building a condo building, can I rent out the units and weather a storm, given how much I'm paying in interest to the bank? Do my loan documents account for extensions enough to get me to a place where we could refi? I mean, a couple years ago, banks just stopped the lending. I mean, I've seen everything. A million things can happen in real estate, and you need to have backup plans to, namely, like, what are you gonna do if it takes longer or you can't lease it up? Is there a different use for that building that you're buying or building? Office as an asset class has completely changed, and no one could have foreseen what was gonna happen in office, but if you were in a really, really great location, hopefully, you could weather some of those storms that happened in office or reposition your office for other uses. I know developers that have taken suburban office space and turned them into, more industrial type uses, like light warehousing or light warehouse office as an example. Like, what are different things you can do to create enough flexibility in your model to where if everything doesn't happen according to your plan, you're not going to lose money for your investors, because that's the most important thing. Risk, unfortunately, is usually evaluated based on apparency and not actuality. I've seen investors invest in things that were actually super risky and appeared safe just because it was, industrial or multifamily, and completely lose. And then I've seen investors invest in things that are, really, really great deals, but appeared to be super risky, like boat and marina storage as an example. Like, marinas and boat storage is an asset class where people have made so much, but it looked risky because it was so pioneering and not a lot of institutional investors were doing it. And so you have to be able to evaluate deals based on actuality and not just what everyone else is doing to understand risk. I've done some amazing deals in my career. I've also lost capital, and it is the worst feeling in the entire world. And I know I will never do it again because I didn't allow for enough cushion and evaluation of risk when I went into a deal. And it was so easy to get hyped up with the market, and there was so much institutional capital flowing and it was so easy to raise capital that I didn't evaluate enough risk. And that is something that I've had to learn the hard way, and that I would instill to anyone here, to really add enough risk factors and not get swept up in how much you like the deal or how easy it is to fund or how hot the market is. Do you have enough contingency in your plan or enough plan Bs and Cs and Ds if something goes wrong to really make sure you're not losing any capital? As an example, I think investing in Nashville multifamily right now is absolutely nuts, and people can still continue to do it, even though if you own a multifamily building, to get it rented right now, you're greatly discounting rents in Nashville. You're giving away months of free rent, but people are still investing in building in Nashville because multifamily is a good investment. So that's an example of how you need to, evaluate your own risk and not just listen to people. I personally have really leaned into condos because I think it's an incredible risk-adjusted return. I have so much more room in building a condo building than I ever did in multifamily, to where if I'm building the right projects, I could discount my pricing by a huge margin and still make money, or it could take me double the amount of time I decided to sell it and I still wouldn't at least lose money. So that's why I went into and focus on, my flexible living condos, but everyone has their own niche, and it's really important they lean into it for those reasons. So when you're evaluating risks in a market, it's very important to understand the fundamentals of that market. What is driving the demand for your asset class? If you're buying a marina in the middle of, nowhere, there are a million boats and a million fishermen that want to use your marina, and like, what is driving demand for whatever you're investing in? I particularly am in building condos, and so I'm looking at a million factors of demand drivers. So I'm looking at how many people are investing in a certain market, like in the Southeast in Nashville. I'm looking at job growth, cost of living, population growth, like basic demographics that frankly a lot of, AI can do the research for you. But to make sure that your demand drivers are really backing up the project that you're investing in. If you're investing in industrial storage as an example, how many users of that storage are there out there? Are you counting on grasping 10% of the market share or 1%? I particularly feel a lot better about needing to grasp 1% of a market share versus 10%. 10%'s a lot. And so it really depends on the size of market you're investing in, how well do you know that market, and the asset class you're investing in. You have to do a lot of research to evaluate risk in each market. When I've raised capital from people that have the most money, they are very simplistic. The smarter and more wealthy people are, they tend to be a lot more simple. They want to know on the back of a napkin how the deal is structured and what the deal is. And, they want to know, hey, I'm spending $10 million on the land. I'm going to spend $50 million to build it, and I'm going to sell it for $100 million. That's the simplicity that a lot of investors that are really, really smart and have the most money want to understand. They count on their super advanced finance people to build them out 20 tabs of spreadsheets that back all of that up. But does it work on the back of a napkin is the most important thing. Because I have always made a marginal amount of money that wasn't worth it when I've had to use a spreadsheet to account for deals. Just, if I've had to really massage a deal to make it work, it needs to work on the back of a napkin, no brainer. And then there's enough room for anything to go wrong. And then usually in that case, you make way more than you said you were going to because there's enough room in it. And you can really zero in on the details and look for better terms for debt or get better terms on the land you're buying or grind down the GC and get it built for cheaper or, do a better build out package that is less than what you thought it would. But you need to have back of napkin underwriting that makes sense is the very first step. So after a decade of investing in real estate, the advice I have in terms of evaluating risk is 1, get an advisory board. That means get a group of people. It doesn't have to be a formal situation, but at least a handful of mentors that have experience in what you're doing and can help you evaluate risk. A lot of times in your own deal, you're blind to the risks, and people that are more seasoned and have seen a lot more deals than you can poke holes in your theory or poke holes in your deal, and they're not super excited about it, and they can be a lot more clinical about the evaluation. So definitely run your deal by, someone more seasoned like a mentor or an advisory board member. Another really important aspect is to have a formal checklist, and there's plenty of templates online where I used to have my deal leads lay out and answer a very long list that had to do with every deal that helped me quickly evaluate risk on whether or not we'd want to move forward. What is, how much are we paying for the land? What is the zoning? Do we have a clear path to zoning? Do the terms of the agreement make us have to go hard before we have any entitlements we need? Can we get debt before we're closing? Like a million questions that, not a million, it's not that hard, but 100 questions on how to evaluate risk in your deal. And having that checklist always get followed by anyone bringing a deal in your team or you yourself investing is very important to evaluating risk so you don't miss something. because real estate is extremely detail oriented. Another thing we like to do is show your investors what the risks are and how you're addressing them so that they know you're thinking ahead and evaluating the risks that, you're asking them for money. You're evaluating the risks that are true and you're figuring out how to mitigate them and reduce that risk of loss of capital. That's really important for investors. It's usually in the form of like a Q&A sheet so that you know how to, mitigate risk essentially. It's also really important to have a plan B in case something goes wrong. I've had, condos sell slower during COVID than I wanted. I bought furniture for them, placed them in service, and rented them out on a short-term basis, and then sold them. That's an example. Industrial buildings, like we've looked at condoing off industrial buildings and selling them versus waiting for a leasehold to come. Making sure that you have a second loan that can come into place if your loan is coming towards expiration. Like things to really account for plan B and things not going as you plan, because there are always external factors, particularly in this environment, that make it hard to, say that you're going to just do a project in 18 months and it's going to stabilize in 6 and then you're going to sell it a year later. I mean, there's so many variables that can happen. Lastly, one of the biggest hidden risks of doing real estate is not having enough capital in your deal. So I've seen investors use very, very high leverage and run out of cash, or get money from people that aren't capitalized enough to see that project through. You always want to partner with someone or raise enough capital to where if something does take a lot longer to sell or you have to drop pricing, that partner is going to ride alongside with you, and you guys are going to both, account for doing enough capital calls if it takes time or a project's going to need more capital. You never want to undercapitalize a project. I've seen a lot of people go belly up because they raised exactly the amount of capital, or they brought exactly the amount of capital they needed to close to the closing table, but then not enough to actually get the deal fully thought through and held and, properly stabilized. So that's lastly another huge risk. I hope that was helpful for you on how to evaluate risk. If you want to hear about a project where everything that could go wrong did go wrong and how I mitigated that risk and got through it and made it a success, please watch this next video.